This is Lunch Money.
Roger Montgomery is, of course, with us in studio. Anne, go ahead.
Yes, thank you for taking my call and good afternoon to you both. I'd like to direct a question to Roger, if I may. What would Roger's view be on the big four banks and his order of value preference on these four as well? And lastly, would it be a good time to take a position in all four?
Okay. And there's no, I think there's no reason to buy your fourth best thing if you can buy more of your first best thing. So the idea to buy all four to hedge your bets and hope that one of them does well, all that does is ensure that if you pick it right, you've got 3/4 invested in things that don't go as well. So for me, I think the Commonwealth Bank is the best performing business, and it will be for another couple of years compared to the others from a return on equity perspective. And the reason I think that is because they managed to buy Bank West at a very, very cheap price from a distressed seller. So that's really boosted their returns. You can see from the share price, though, that it's done nothing for a long time. And in fact, the intrinsic value of this company, or the price at which I would say you're looking in at bargain territory here, is about the $46, $47 level. In fact, $46.68. Not to put too fine a point on it, but you know, the reality is that that the Commonwealth Bank, out of the four majors, and I really think we're seeing a changing of the guard here, because I think Commonwealth Bank and Westpac are significantly better businesses than ANZ and the National Australia Bank. So out of the four, Commonwealth Bank is the pick in terms of quality, and I'd like to see it fall quite a bit before it becomes a bargain.
Because I suppose with this sector generally, the commentary, and again, you're looking longer term, but the day-to-day commentary, and especially the last 2 days, has been about the headwinds that face not only the CBA, but the whole sector.
Sure.
It seems to get that bearish tone on the banks for
yeah, but
the
you know, I mean, I hear these experts come on and say, you know, you've got to watch out for this and you've got to be careful for that. And then the next day, they're, oh no, we're not worried about that anymore. We've moved on. You remember that a lot of their comments are driven by the need to create commissions, and I don't mean that in a denigrating way at all. But you know, activity is what the industry is about. You know, buy, sell, buy some more, made a mistake, sell it, change it around. I'm the reverse of that. You know, I want to have a really simple life, and I want to have as little activity as possible, so I can do the things that I enjoy. And I know, like, let me say this: I enjoy doing this, but it doesn't require me to be buying and selling every day. So rather than watching individual economic figures, ask yourself, you know, do you think we're going to go into a depression? If you do, then you know there's really nowhere that's safe. Do you think that, or except perhaps cash, do you think we're going to have massive inflation? Well, there is nowhere to hide in that case. Or do you think, you know, we're going to have a bumpy period where people will decide that it looks tough and it looks good and it looks tough again? If that's the case, and that's what I think we're going to go through, then you want to buy good businesses when they're cheap. Now, the Commonwealth Bank is a great business. If you live on an island, you want to own a bank. Because if people can't leave the island, they've got nowhere else to go, and you can charge them to put their money in, you can charge them to get their money out, and you can charge them to look at how much they've got. And that's a great business to own on an island. So I think the banks are in a unique position. They've got wonderful competitive advantages that are going to be sustained for a very long time, but you just want to buy them when they're cheap. That's all.
Okay, what about outside the Big Four, though? Because with the GFC behind us, some of those smaller or regional banks are picking up a bit of business. The competition may be starting to heat up a little bit more, particularly in the deposit space, just as an example. But do you see anything you like in those banks? Well,
I don't think you can make the assumption that the GFC is behind us. You've got people like George Soros who says we've only entered Act 2. You know, so it may be that the GFC isn't over. I agree that economic growth in Australia is slowing down. But again, I come back to the point, in answer to your question, I come back to the point that, you know, why buy the second, third or fourth or fifth best thing when you can have the best thing? And the only reason you might compromise is if the second or third best thing was at a deep discount and the best thing wasn't. Well, then you might compromise and buy less of that thing. But that's not the situation right now.
All right, let's get another question from a viewer or caller. Mick from Melbourne, you've got a question. Hey, Mick.
Yeah, g'day, Roger. Thanks for taking my call. My question was in regards to Forge Group. I've been thinking of buying some shares in them, and I'm looking at another entry point, and I just wanted your opinion on Clough Limited, because apparently they
own a big stake in Forge.
A major percentage. They got them at a reasonably good price, but they don't seem to have benefited from them. Am I better sticking to Forge, or is Clough an entry point?
No,
I'm not sure.
Look, in answer to that question, Forge Forge and Decmil are two, if you like, mining, contracting, engineering type businesses that have the potential to be Worley Parsons or Monadelphous of the future. They are terrific businesses. If you look at them closely, they have different customers. Arguably, Decmil has a better quality of customer than Forge, and they have different ways of charging for their contracts. Both of them are cheaper than their intrinsic value. Both of them are A1 businesses. Clough managed to get a steal for the price that it paid for its 30-odd% stake in Forge. But I still think that Clough isn't cheap compared to its intrinsic value, whilst Forge is. Just bear in mind that cornerstone stake can be a positive and a negative. A positive in the sense that it makes the register stable. It means the business can focus on what it's doing, and it's got a strategic partner. A negative from the perspective that, well, no one else is going to come along and make a takeover bid with Clough there as a cornerstone investor.
You said it's an A1 company again. So you said you only got about 5 of those before?
Oh, no. There's a handful. There was only 5 A1s or A2s back in May that were cheap.
Oh, that's right.
Yes.
So how many have you got there now?
There's probably a couple more. That's why I've bought a few things recently.
Yes. All right. Good stuff. And good to get your question, Mick. And I know there's some more coming through. So I think we just have to take a quick break. Roger, we'll talk strategy with Roger Montgomery from RogerMontgomery.com. Jeffrey, have we got you there?
Yes, we got me here.
Excellent. You're on the air with Roger, ready to take your call.
Roger, could you comment on Asiano?
Yes. Yeah, I can. Tell me, what do you need to know?
Well, I'm a long-term investor, and I usually depend on the return on assets and the acceptance that if you've got good assets, the share is going to survive. And for instance, if the management was awful, there's someone else who won't waste time and step in to buy the assets anyway. So it's a good sort of foundation to base one's long-term investments.
Sure. Jeffrey, let me recommend a book for you first. It's by a gentleman whose surname is Schwab. And it's a great book. It's called Pigs at the Trough, and I'm recommending it as a book we talked about Telstra earlier. It discusses Telstra. So can I just suggest that you either buy that book or go to your local library and ask them to buy it so that you can read it. In regards to Asiano, I rank companies based on a bunch of ratios and the changes in those ratios over time. And I rank them from an A1, which is the highest quality business, all the way down to a C5. Asiano gets, on my rankings, and this can change year to year, but on my rankings it's a C4, which is the second worst rating. So for me it's not investment grade, and if it was my money, I won't be buying this for myself. Now, that's not a recommendation for you, of course, to go and do anything at all. You need to speak to an advisor who knows your circumstances. But the intrinsic value that I have on this business, if I was interested in buying it, is 60 cents. And that's $1 less than the current share price of circa $1.60. So it's neither cheap nor is it a good quality business.